Hello, everyone. This is Justin Smythe from nextbigtrade.com. This is your weekly index review for March 15th, 2024. Starting off with the S&P 500 on the weekly chart, you can see the S&P 500 was down just slightly for the week, and volume was heavier to the downside this week. It was a quad witching day on Friday where options and index contracts are expiring, which tends to cause a massive volume spike. And this happens about 4 times a year. But overall, volume continues to accelerate to the downside with selling pressure coming into the market. And the weight of the evidence suggests that the first major stock market correction of the year is now starting. We'll dive into that in the newsletter and in the sector review and in this review as well. But if you look at the big picture, the S&P 500 is now up about 48% coming out of the October 2022 lows, and it's up around 36% from the March 2023 lows, which is just about a year ago. So big gains for the S&P 500 after the bear market low and after the correction low in March 2023. And now there's potential for the stock market to correct a lot of that gain and probably move back down towards the 30-week moving average. We haven't retested the 30-week moving average since the October 2023 correction, and the stock market tends to retest this moving average during major corrections. And the S&P 500, again, is coming off of its most stretched position to the upside against these long-term moving averages in multiple years now. So it's ripe for a major correction. And there's a number of things that could really accelerate this correction to the downside. We'll touch on that in the sector review in terms of the bond market and in terms of the financials. There's some negative things going on in those markets. Dropping down to the daily chart for the S&P 500, you can see that quad witching volume on Friday, but overall there was selling pressure coming into the S&P 500 before the quad witching on Friday, and we're just starting to get down to that 20-day moving average. This is really the only part of the timing model that hasn't triggered yet, where we're still trending above this shorter term daily moving average, but there's a good chance we're going to start closing below it as early as next week. And again, you can see in past cases, if you look at what happened coming out of the July 2023 top, a little bit of volume starts coming into the market on the downside, selling pressure. This occurred right after a volume spike higher, potentially more selling into a top. And then, the accumulation volume didn't start again until the stock market bottom in late October, early November 2023. So now, if selling pressure continues, we would be looking for a correction and then looking for buying pressure to finally come back into the market sometime later, after the correction has time to play out. So really overall, the name of the game is letting things play out now and being patient, while the market tries to process its first correction of the year. Looking at the NASDAQ 100, again, technology continues just to underperform. We're about to cross below relative strength against the S&P 500 here. This relative weakness has been going on for weeks. And then jumping down to the daily, we're already breaking below that 20-day moving average here. And there was heavy volume selling across, multiple stocks in the Magnificent Seven this week. And you can see the selling volume that was occurring this week on the daily chart. NASDAQ Composite was down more than the S&P 500. Again, technology is underperforming. and this is occurring later in the cycle. And the small caps were beat up this week, down over 2% for the week on heavier volume selling, and they're continuing to underperform the S&P 500, which is typically bearish and happens during a weaker market. The same thing is happening with the Russell 2000 growth, down over 2% on heavy volume selling this week. Jumping over to stock market breadth, the percentage of stocks in the S&P 500 above the 50-day moving average declined this week for the first time in a few weeks. This indicator is overbought and has plenty of room to move lower now, especially if we're in a correction. This will probably move back down to an oversold level below 20% before this correction is over. And that's where a new buying opportunity will likely present itself. So again, this is another great indicator to pay attention to look for major bottoms after corrections. You tend to see oversold breadth with many stocks below the 50-day moving average. The last time this occurred was after the correction in late October 2023 was over, which was another great opportunity to buy stocks with the S&P 500 coming out of a correction. Turning to the VIX, again, we've been talking about the VIX failing to break out for multiple weeks. The VIX did move higher this week, or it basically bounced off the 10-week moving average, did close slightly lower for the week, but is still in position above the 10-week moving average and in position to break out here. So if more selling pressure comes in next week, this is finally going to break out. And again, as long as it's closing above the 10-week moving average, that tends to occur when the stock market's in correction. So this is another good indicator to just pay attention to. Once you get that close below the 10-week moving average, like we had in October 2023, and like we had at the end of the March 2023 correction, that tends to indicate that the market is done with the correction. So right now we're still above the 10-week moving average, which means we're still potentially in correction. And finally, turning to these inverse ETFs, last week on the focus watch list, these three ETFs were on the list. Big volume came into the inverse semiconductor ETF this week after, huge volume last week. There appears to be massive accumulation here to hedge the recent upside in semiconductors. I think this is ripe for a major breakout heading into next week. As there's lots of profits in these semiconductor stocks that is being unwound now and distributed by major institutions. So good potential for breakout next week here. The same thing with the inverse NASDAQ 100 ETF, big volume coming in again this week. And then finally, the VIX ETF UVXY was down slightly for the week, but big volume came in again here, and it closed off the lows of the week. So overall, the institutions look like they're distributing, these big winning stocks at this point. Selling pressure is coming into the markets after a major run higher. If you look at the timing model, the only thing that hasn't broken down is the trend of the S&P 500. But if that breaks down next week, then the weight of the evidence just continues to suggest we're starting a correction. And there's a number of reasons why this could be potentially the biggest correction of the year and could wipe out most of the gains of 2024. So we'll continue to watch, some of these key indicators moving forward. But, the name of the game right now is to move to the defensive side and to let the correction play out, which will provide another amazing opportunity in the stock market after the correction is over.